So now we have the Fed on watch still. They are not going to ease. Their fingers still on tightening. ECB, Bank of Japan, and Bank of England, all still probably done tightening, but they're not even started easing. That's been my iteration. Let's get to the first bridge of the start, take out that priced in tightening, and then the start easing. Then we can think about when risk assets will bottom, and they're just getting started. So reiteration from our economics team this morning, Bloomberg Economics, the recession will hit by the end of this year. I think it's going to start it. And Anna Wong pointed out virtually every time we've had significant recessions, 3 or 2 months before that, you see non-farm payrolls plus 300. Now, we've just seen that pretty strong number.
The Bank of Japan took another step in relaxing its control over long-term interest rates by making adjustments to its bond yield control policy on Tuesday. This move signifies a gradual shift away from its decade-long controversial monetary stimulus. While maintaining ultra-low interest rates, the Bank of Japan diluted the 1% cap on the 10-year bond yield, which had been set just 3 months ago. This adjustment allows long-term borrowing costs to rise further. In addition to these changes, the bank's board raised its price forecasts, projecting that inflation will surpass its 2% target for the current year and the next. This reflects the growing confidence within the Bank of Japan that conditions are aligning for the gradual phasing out of its super loose monetary policy. The video that follows features McGlone providing a review of the macroeconomic conditions, which contrasts with the developments seen in the crypto world. McGlone reiterates his recession predictions and discusses the potential price impact of oil as the conflict in Gaza continues.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
The word hopium for the bulls is what's happening. It's rallying and closing strong on Fridays because people are afraid to be short for the weekend because of what might happen with escalation in the war in the Middle East. Now remember, when you're people like we are, you've heard that term war in the Middle East since you were children. It's unfortunately, it's just something we've grown up with. It's sad, it's horrible. But the thing is, will it do anything to significantly cut the supply of crude oil, like the Arab oil embargo in 1973 and the in 1979, the raiding of the U.S. Embassy? And it's very unlikely. So here we are back Monday. WTI is around $84 a barrel. The average price this year is 77. Most people last year said there'd be a 1 in front of that handle. And yes, if you want to blame someone, I think it's going to 50 or below in a normal recession. And that's already what's happening. So crude oil is bounced, but it's up 4% in the year. Gold's up about 10% in the year. So that's a significant, and copper is down about 5%. So from a commodity standpoint, that's a clear recessionary trajectory. And the only thing they need the next shoe to drop is for crude oil to fall with the U.S. stock market. So we just got off our morning meeting, and something that was completely expected is lower prices are begetting lower prices, almost all risk assets. So we're at that stage now. It's crude oil is going down because the stock market is going down. And why is that going down? Because the Fed's still tightening. So now we have the Fed on watch still. They are not going to ease. Their fingers still on tightening. ECB, Bank of Japan, and Bank of England, all still probably done tightening, but they're not even started easing. That's been my iteration. Let's get to the first bridge of the start, take out that priced in tightening, and then the start easing. Then we can think about when risk assets will bottom, and they're just getting started. So reiteration from our economics team this morning, Bloomberg Economics, the recession will hit by the end of this year. I think it's going to start it. And Anna Wong pointed out virtually every time we've had significant recessions, 3 or 2 months before that, you see non-farm payrolls plus 300. Now, we've just seen that pretty strong number. I looked from our interest rate team, Ira Jersey, pointed out the big deal this week is that refunding. 114 billion treasuries. I remember trading in treasuries, and 40 was a lot. So here, what that is, that's a giant black hole of high yields, guaranteed. People know, I bet at this conference, people saying, where you put your money? I'm like, well, what's wrong with the two, And that higher yields is sucking that money from risk assets. It's actually pressuring things like housing and anything that's related. So I'll point out that to me is a key thing. And also we have this dollar bull fatigue. So what's it going to take for that wrecking ball of the dollar? I mean, the yen is above 150 now. Is basically you need yields to fall, U.S. stocks to fall, and that's part of the worst lose-lose. So I'll end with this. Since the U.S. government, went above 5% on the first day, it really sustained above that level on August 21st. The S&P 500 is down about 7%. Gold's up about 5%. And crude oil still hovering up 3% or so. I think everything is going to tilt lower, and that's what's good for gold. And the bottom line is Bitcoin is showing divergent strength in this environment.
Surprisingly, one of the most attractive investments on Wall Street is a somewhat unexpected choice. It involves a battered long-dated Treasury bond fund, specifically the iShares 20+ year Treasury bond ETF. The shares of this ETF are currently close to a 16-year low, having experienced a decline of over 50% from their peak in 2020. Despite this, investors are flocking to it, injecting over $2 billion into the fund on Tuesday and Wednesday alone. This brings the total inflows for the year to an impressive $21 billion. In the following discussion, Melker shares his perspective on this trend, encouraging both investors and traders to take a bold approach and casting aside caution.
One of the worst performing assets last year was GBTC. It's one of the best performing this year. I still bullish that asset, but TLT has been one of the biggest surprises, particularly here. Guilty, wrong. I didn't think long bond 10 years ago about 4%, but now they're 5%. I think they're going to drop on the elevator towards 3% with the deficit ballooning, with QE that you mentioned. Now that's a bridge to come to, and then it's after that I don't know what's going to happen. We're going to unfortunately, we might get austerity. Republicans coming, they're talking austerity already with the new Speaker of the House. So what does that mean? That's a depression. And that's kind of what they did in the 30s. And we raised taxes, and we had Smoot-Hawley tariff act and things like that, but we're tilting that way. So in the macro right now, I think this is pretty significant that we're seeing this asset that's 3 times the volatility of the stock market and gold, Bitcoin, doing well when everything else is tilting lower. Now, the key thing about the stock market you have to look right now is, yes, 14-day RSI is oversold. When have you ever seen a bear market that doesn't get oversold? And this is historic and epic. And the key thing I want to point out in my presentation is never forget where you came from. And it's a simple fact that if you use a simple Warren Buffett model versus the S&P 500, just a year ago was the most expensive since 1936. We're just simply reverting the most historic period in history of low interest rates. The facts have changed. Okay, and here we are working on a day-to-day. Everything that's a risk asset is supposed to go down in the environment, and that's why the federal government is part of the problem now. They've borrowed so much, we're at the limit now. And you mentioned, Dave, at some point there's going to be QE because the Fed can do it, but they're going to have to. And also, a lesson I learned last year, I remember with some of my colleagues who were bullish crude oil right before the midterms. I'm like, don't underestimate what the world's largest producer, what helps get a sitting electors, politicians elected. They need lower crude oil and things like that. So expect pretty strong austerity, not austerity, but priming the pump. And at some point, this is epic, but this to me right now, the situation I see around is very akin to 1930. Stock market went down 50% in 1929, rallied 50% and rolled over, and everybody thought it was over. All the indicators we have, it's just getting started. That was just the warning sign. So the key thing is they're supposed to issue 3s, 10s, and 30s year securities, 114 billion. And if they issue a little bit less 30 years than the market anticipates, which I think they will, that will give you a signal that, okay, well, we're starting to focus on this spike in long bond yields, and we think it's serious. And we'll see what happens. But right now, the market's already expecting that. I mean, it's expecting the supply. The key thing is when the supply comes on, if it spikes yields shorter term, that's just a black hole for risk assets. You see the lose-lose here. The Fed's going to keep borrowing. The Treasury is going to keep borrowing. And at some point, it's just going to be overwhelming when people realize, okay, well, these yields are just too attractive, and I got to lock up and protect myself. And every time they inch higher, I pointed out what happened with the 2-year note, above 5%. All risk assets, they just have that ceiling, that wall of resistance above them for this massive need for borrowing from the safest risk assets on the planet.
The Federal Reserve's latest monetary policy meeting commenced on Tuesday and is set to conclude with the announcement of its latest interest rate decision on Wednesday. Market expectations strongly lean towards the Fed maintaining the current interest rates. Investors are particularly interested in any hints about whether the Fed has concluded its series of rate hikes, as indicated by guidance released alongside the rate decision and Fed Chairman Jerome Powell's subsequent press conference. Recent weeks have seen several policymakers expressing the belief that further rate hikes may not be necessary. Tighter financial conditions, attributed to higher Treasury yields, are often cited as a key factor, with higher yields typically associated with an easing economy. Investors also assess the economic landscape following the U.S. Treasury's disclosure of its borrowing plans for the last 3 months of 2022, revealing a borrowing target of $776 billion, which is below earlier projections. The Treasury Department's announcement, made on Monday, reflected an updated estimate influenced by higher-than-anticipated tax collections in October. This adjustment, $76 billion less than the August estimate, is attributed to deferred tax collections in states like California, where deadlines were extended due to extreme weather conditions. The impact of these new estimates on upcoming auctions for bills, notes, and bonds will be revealed on Wednesday morning, potentially influencing bond prices and yields. The Treasury's adjusted plans suggest a lower-than-expected issuance of bonds this quarter, raising questions about the potential implications for the broader economy. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.